Hey everyone, welcome back to the Daily Gold Podcast. Today we're speaking with Tiho Brkan, who is an author of the great blog titled The Short Side of Long. He's also a fund manager based in Hong Kong, and he's also part of an exploration company in Australia. Very busy man, Tiho. It's so great of you to join us. Why don't we get started off with talking about bonds, because you wrote a post today about bonds, and before we got on air here, you were noting the difference between the fund flows going into treasuries and government bonds versus corporate bonds. And so when we're talking about bonds, a lot of people just focus on government bonds, but what's going on in the corporate bond market all the way down to the junk bond market, I think that's very important, and that's something you've been keying on for the last couple months. So why don't you discuss what your thoughts are on that?
Sure. Well, first of all, thank you for having me on your show again. It's always a pleasure, as you know yourself. Regarding the bond market, yes, it's a very space. It's a large. We have a variety of sectors in the bond space, so we can't just assume that when equity flows leave and enter the bond funds, automatically that means treasuries are bid up, which majority of the investors are quoting. You know, when we have a herd mentality, majority of people just repeat themselves and say, "Oh, funds are leaving, equity flows are moving out, and automatically those funds are going into bonds, so therefore we should try to be contrarian." Because if we have a look at what's been happening over the last, say, couple of years, or even a couple of months or this year, majority of the money that's leaving equities is coming into mortgage-backed securities, emerging market debt, high yield, junk debt, and investment-grade debt. So we're not really seeing a lot of inflows from what I see from the research that I track, bonds and treasuries. So I would be very careful into assuming that automatically that's a buy signal for equities and a sell or a short signal for treasuries, because as the big business cycle progresses towards the later innings, and we're now approaching a point where we could have a downturn or a slowdown or even possibly a global synchronized recession, as I've been predicting on my blog, sometime into 2013 or 14, we could actually see a surprise where money leaves these riskier, higher yielding bonds, which have received majority, if not almost all of the fund flows, and also equities, and therefore this money could flow back into treasuries. Now, I'm not optimistic on treasuries because they're very overvalued, and they've been in the bull market for 31 years now, since September 1981. But I do have to say that when investors get forced out of certain risky assets because of fundamentals or a downturn, fall in earnings, fall in margins, they might not have any other place to go other than buying these so-called safe havens.
Okay, so I mean, just a quick follow-up on that. Let's say your economic forecast is correct, then then do you feel that the money that's in the lower quality bonds is essentially going to go back into government bonds, at least temporarily? Is that what you would expect?
Well, yes, exactly. I mean, if we have a look at the sentiment since, for example, since June 2012, when the S&P 500 bottomed at 1266, 1st of June 2012, we've noticed that the stocks have rallied, and since then, emerging markets, mortgage-backed securities, corporate grade bonds, and junk bonds have all rallied, and they all received an amazing amount of inflows. Quite a strong exposure. I mean, you can see these charts that I've presented on my blog if you visit the recent post. At the same time, since that bottom occurred, safe haven assets similar to treasuries and maybe the US dollar, as well as the Japanese yen, have been sold down, and investors have left those assets, and they've underexposed them, and these assets have now become unloved. So if we have a reverse trade of where risky assets, risky bonds, risk equities come under pressure in the future because of disappointing earnings or deterioration in economic activity or the physical cliff or the resparking of the European problems or the China moving closer towards the hard landing in its property sector, all of these things can create a risk-off environment, and that's when we can actually see this hot money that rushed into these speculative bonds quickly reverse and come back into treasuries and the Japanese yen, most likely.
Okay, now secondly, I want to talk about the Japanese yen in Japan because that's something we talked about beforehand. I mean, obviously, as you said, very few people are interested in Japan because it's been performing so poorly, even after the bottom in 2009. I mean, the Nikkei is trading at 8,700. It bottomed just below 7,000, I think. So that's not a very good recovery there, considering the recovery in other markets. I mean, what has to happen for there to be a real opportunity in Japan on the long side?
Sure. Well, first of all, when we look at the Japanese Nikkei, um, one has to distinguish between short-term, medium-term, and long-term. Uh, I like to start with the top-down approach. So when we look at the long-term uh, outlook of Japanese economy and the Japanese stock market, and we have to understand that those two are different. They're not the same. The Nikkei peaked in late 1989, early 1990, around 39,000, almost touched 40,000. And since then, for over 22 years now, it has been in a secular decline or a secular bear market, and it's gone, as you said yourself, in March 2009, it's gone as low as 7,170, or a little bit lower. Currently, we haven't had that much of a recovery at all, and we're still sitting along the bottom 3-4 years later, and while the S&P 500 is close to 2007 highs. Obviously, there's a variety of reasons why this is happening, but one of the main reasons is because the Japanese yen has been so strong. It has been in its own bull market for the last 4 or 5 years, and it's gained a lot against the US dollar. So Japanese equities priced in US dollars actually have done a little bit better than the Nikkei itself looks. Now, over the short to medium term, it's come to my attention that after reading today's Merrill Lynch Fund Managers Survey report that global hedge fund managers, pension fund managers, and other fund managers have become extremely underweight, have turned extremely underweight towards Japanese equities, the most since actually March 2009 lows. So when we look at Japanese equities, they're almost 80% below their all-time highs, priced in Japanese yen. They're also very underloved. They're very underexposed. And at the same time, the valuations are very, very good because an equity market that's been down for 22 years still, majority of the time shows good valuations because bottoms are not made in 3 or 4 years. They're made in a generation or two. So the price to book valuation or the cyclically adjusted price to earnings ratio is in single digits, and these valuations are very, very compelling. Having said that, over the short term, like I said before, Japanese market tends to correlate in the opposite direction to the yen majority of the time, and also to the treasury market. So since we had this risk-on environment and treasuries have been sold down a little bit, and we've seen outflows coming out of treasury market, and at the same time, investors have now turned a little slightly bearish on the Japanese yen. What I think might happen is when the risk-off scenario starts, we could see Japanese yen and treasuries rally, and this could put some more pressure on top of the current decline in the Japanese equities. So while I think they're a great purchase in the long term, I'd still hold out a little bit. I mean, I myself don't have any exposure in this market right now, but am really looking forward to getting an entry point, and hopefully they do go down a little bit lower before this opportunity presents itself.
Now, before we get to precious metals, Tiho, something I haven't mentioned to you, but I noticed this on your blog, and I pulled up the chart as you were speaking there, and you show the S&P 500 and below. You show the Treasury 10-year break evens going back to 2006. I know that looking at these break evens, it's sort of a measure of inflation expectations of sorts. Can you educate us on exactly what that means? And secondly, I've seen these charts, and it looks like, as far as the inflation expectations, these charts are pretty close to breaking out to a multi-year high. I mean, is that any threat in the next year or so that we get a breakout in the break evens? And does that kind of lead to stagflation or something of that sort?
Yes, I understand. Well, first of all, regarding educating your listeners, I'm probably not the best person to be doing any educating because I'm always a student myself as well. So you probably shouldn't take any advice from anyone on the internet that tells you anything, including myself. You should always do your own research and lose and make your own money. Regarding what I write on my own blog, it's my own personal trading diary and the way that I view the market and the global macro conditions. And I guess I write about what I see and what I plan to do with my own money. So one of those things, as you mentioned yourself, has been the break-even rate, which is, I guess, market's way of measuring future inflation expectations. Now, an interesting thing has occurred since the crisis of 2008, where Bernanke and a majority of other central banks have gone down towards the ZIRP policy, which is the zero interest rate policy. And what we have here now is that inflation itself, or the rate of change in inflation, has become a tightening or loosening instrument or a tool that the market itself does to I guess, keep a lid on inflation or deflation. Central banks, being at zero, do these monetary programs, and they try to so-called print money, add reserves to their balance sheet. But at the same time, it seems to me that the market really front runs what they do, and the market really drives these inflation expectations while the central banks just follow. So since 2008, you can notice on the chart, if you visit my blog, that majority of the time when inflation expectations have reached a certain level on the upper threshold, we've had so-called overheating of the economy in the short term, where price pressures become too great for consumers and businesses to handle, and both the consumers and the businesses will pull back on their consumption, or they'll delay their consumption. This usually tends to sell off risk assets, which tend to correlate very closely together, as you know yourself. So, these would include something along the lines of S&P 500, the DAX, emerging market index, Canadian dollar, Aussie dollar, New Zealand dollar, the commodity currency space, as well as junk bonds, maybe even sometimes corporate bonds, as well as copper, crude oil, etc., etc. At the same time, when the threshold of, I guess, deflationary warning or is reached in the break evens, what we tend to notice is first the Fed will react. They reacted with QE1, they reacted with QE2 around those times, and they've also reacted with Operation Twist. And they'll get worried that the current decline in prices, be it equities or real estate or the CPI rate, is spiraling out of control, and they don't want to see any deflation, as Ben Bernanke has told us so many times. So what they'll do is they'll try to create some type of an re-inflationary policy, a monetary policy stimulus, where they would try to push up equity prices and create the wealth effect, or push up the CPI and things like that. Obviously, bad consequences as well, because it pushes up the price of energy and food and etc., etc. One thing that's very interesting about the inflation expectations, the so-called break-even rate, is that the recent program that General Ben Bernanke and his minions have announced, the QE3 program, or the QE Infinity, or there's, I think, numerous names for it now. It was announced when inflation expectations were already relatively high. While they weren't extreme, they were decently on the upper end of the range. So the market was much closer to overheating and sort of adjusting or correcting for a little while, where consumers and businesses will pull back on consumption. But what Bernanke did is he didn't wait for deflationary pressures to sort of show their risk as before, where the VIX would spike and break-evens would enter a territory which is associated with QE1, QE2, Operation Twist, etc., etc. He just instead looked at the job rate, the unemployment rate, and the participation rate in the American economy, and said, this is becoming structural. So what I'm going to do is I'm going to start QE straight away. This has actually pushed inflation expectations rapidly higher, and it's sort of linking up now, in my opinion, to a peak in some risk assets. Now, since that's happened, crude oil has actually sold off from $100 to towards $90 a barrel. S&P has stagnated and going up. At the same time as well, we had a rally in the precious metals and in industrial metals on anticipation of this QE, but now they've stagnated as well and they're correcting somewhat. So I'm not sure how it's all going to play out, but you'll notice that whenever inflation expectations, the so-called break-even rates, reach the extreme upper range, majority of the time, risk assets such as commodities, currencies, risk currencies, or equities globally have corrected. Different times we've had a different top for different asset class, but majority of the time, one or two or three or maybe all of the asset classes will tend to top and correct. And if that was to happen again, I assume that since QE3 is now unlimited, and if risk assets do sell off, it'll be only a matter of time until break-even rates reach the lower range of deflationary risk, at which point in time, Bernanke will increase the monetary purchases of treasury, I guess, mortgage-backed securities and also treasuries to the equivalent of maybe higher than $40 billion a month. And at that point in time, he'll start stimulating more and more. He'll printing more and more money until whatever outcome he's after, which, in my opinion, won't happen anyway.
Right. Okay, now, Tiho, before we close, how about some thoughts on the precious metals complex? I should note to everyone that while you're bearish, and you've been vocally bearish recently, you're using your bear positions as a hedge because you're a huge believer in the bull market in commodities, and especially in precious metals and agriculture. So why don't you give us a few thoughts on gold and silver here?
Sure. Well, that's exactly right. So my position, my book is I'm extremely long precious metals, especially silver, and I also have whole positions in agriculture, overall agricultural complex, but I'm also looking to buy some more precious metals and soft commodities very soon, depending on how prices play out. But you can never be 100% correct. I mean, even though we do have a precious metals bull market, no one really knows how far it will go. No one really knows if it is still going. I'm pretty certain it is, but we don't know the future, and no one really knows the future. So to protect myself, especially because of all the fundamental deteriorating economic data that I see occurring, while majority turn a blind eye to that and think that central banks can create further economic activity and stimulate the economy by printing money, I don't actually think so. So, I have shorted other assets as a hedge, and I am bearish, that's right. So I have shorted assets such as stocks that are in a secular bear market, and they've started 2000, and they still remain in a secular bear market at the top of their range. But at the same time, I remain bullish on commodities. So regarding silver, regarding gold and silver, we should really say, gold peaked a little bit later than silver, as majority of your readers should know. Silver peaked in May 2011 at around close to $50, and then it corrected down into December of, I think it was 2011 at around 26. I made a purchase there, and also it corrected again June, July at 26. Once again, that support seems to hold. Of 2012, I also made a purchase there, as your readers can have a look at it on my blog, which I regularly update. At the same time, gold peaked a little bit later. It peaked in August 2011, and it also corrected down towards, say, 1530 level on those similar dates. What concerns me about precious metals is that gold's been up every single year since the bull market has started. Now, some people say that's not a huge concern, and maybe they're right. I don't really know, but I would prefer to see a proper correction in gold to the point maybe where it falls down to 1300 or so. It has a losing year, and then there would be a sound base. There will be a washout where we can start to rebuild a new bull market advance. Similar to what happened between 1970 and 1980, where in 1970, I think it was 1974 to 1976, about a year and a half, gold had a very strong correction, and then after that, it went up a lot. I'm not sure if that will happen, but if it doesn't, gold could continue to advance here, especially because it has a catalyst now, So the way I look at gold and silver, long term, I'm very, very optimistic, but short term, they have been resembling some type of, I guess, short-term euphoric feel where the open interest on the COMEX has gone up quite a lot. The exposure in the GLD ETF has gone up dramatically by retail investors. Hedge fund positioning, according to the COT report, has also gone up quite a lot rapidly. Various sentiment surveys showed kind of optimists or bulls relative to bears in around September. So, there are some short-term negatives. Maybe gold price will sell off. Maybe silver price will sell off. And if it does, hopefully we're all smart enough to buy some more gold and silver. But, we're still in this very good seasonal period that starts around summer, maybe June, July, August, and tends to last until next year around February. So maybe gold can continue to grind high here. I'm not very sure of the short term what gold will do. Gold and silver tend to move opposite to the US dollar some of the time and tend to correlate to the stock market other times and tend to follow fundamentals other times or tend to listen to what Bernanke says at some other times too. So over the short term, it's very difficult to predict this market. I think the recovery of some type occurring in silver, which sold off 50% last year, and also gold mining shares as well, which I think a majority of your listeners are exposed to. But at the same time, there's always risks and there's always something to keep us up at night in regards to any bull market. That's what they say. I guess the bull market climbs the wall of worry.
All right. Well, Tiho, on that note, we'll in the future we'll try not to listen to everything that Bernanke tells us. And so thanks so much for your time today, Tiho. I really appreciate it.
Absolute pleasure. Thank you so much.